Good morning and welcome to the Killik podcast for Friday the 22nd of May. Relatively quiet week for markets in terms of macro data. We've got two issues we're going to talk about, but then we're going to talk about stocks. So on the macro, we had the April FOMC minutes. Didn't really say anything that we didn't know already. Weak growth in the US. Perhaps more interestingly, they talked about the unemployment rate and the fact that we're moving towards full employment. We're starting to see wage growth accelerating. We've seen that at the company level through McDonald's and Walmart raising their rates of pay. Then in Q2, in terms of the data points we've seen this week, both pieces of data actually quite soft. So we saw home sales fall in April, and we saw the Philly Fed actually come down a touch. So not a particularly encouraging outlook there. In Europe, the ECB actually surprised the market probably in response to that rise in yields that we've seen in the bond market that we were talking about last week, and they're going to front-end load the QE program. So that gave markets a little bit more confidence, and we saw the euro sell off against the dollar, as you can see here, and we saw a corresponding increase in the DAX. So ECB remaining very supportive to equities. So looking at the picture in the whole, growth is slowing, wages are rising, cost of debt is rising, markets are at highs. So should we be more nervous? So as we said last week, investors have lowered the rate of the return that they're requiring from equities because they see the lower rates of return in bond markets. So to date, the equity risk premium has absorbed that move in bonds. That we feel is there's still further to go there, but you've got to absolutely keep an eye on the pace of increase in those yield increases. Otherwise, we'll have a similar sort of position to what we had in 2013. And I think it's very supportive to markets to see the ECB coming in and trying to slow down that pace of yields coming up, and the FOMC minutes were doing a similar sort of thing. So volatility, we've got to be aware, could pick up if this growth that we're expecting in the second half doesn't come through. Bad news at the moment isn't quite bad news, as we've seen from markets, but it could well become bad news in the second half, so we've got to watch that closely. On a more positive note, bottom-up estimates, we think, have now actually bottomed and starting to rise in terms of the company EPS forecast. And we remain confident on the dollar strengthening, the consumer continuing to grow their spending and lower their savings rates, which picked up in the first quarter this year, and that steepening yield curve benefiting some sectors in the market. So we're supportive of banks, supportive of the consumer, slightly more negative on staples that look fully valued, and utilities, and they'll be affected if bond yields actually go up and the relative valuation starts to diminish. So that's kind of the broader picture. So week ahead, we've got Cineworld coming on Tuesday and Michael Kors on Wednesday. Those are the Killik stocks. Just talking about consumer discretionary, Michael Kors. One of the reasons why we like this sector is that we are, as we said, seeing average hourly wages going up in the States. We've also seen very strong consumer confidence picture, and here we've got those gauges on the chart. So that's at odds with the share price performance of Michael Kors, and we've also got Harley Davidson, which our research team initiated on this week. So we want to see that consumer confidence starting to pick up in those sales, and we're still optimistic that will be the case. So that is a PED rating, as we talked about previously. So just looking at our best ideas, we've got a new best ideas list that was published yesterday. A few changes, some of the ideas like Disney, Syngenta, which had a bid, BT, Airbus have come off the list because of very strong performance. Harley Davidson's come on for Michael Kors. We'll talk about that in a second, and we'll just run through a few of these ideas. We talked about Aberdeen in the past, and this is just a reiteration of the fact that this is a cash flow build-up idea. As you can see here, no buybacks and 10% dividend increase per annum will quadruple the cash flow in the business by 2019. And you can see the different scenarios for a 10% dividend, no buyback, with buyback, and a buyback with 15% dividend there. Barclays, again, is a valuation play. Here, the comparative valuations, it looks cheap on PE. but also on return on equity to price to book. You can see Barclays there. Very interesting to see that price, that share price was not negatively affected by the FX issue this week and the payment they had to make. Obviously, the market had a bigger number in mind. Heidelberg Cement, which I haven't talked about very much. This is about construction pickup. They've got a big market in the UK, and as you can see, the per capita spend on cement is very low in comparison to the rest of Europe. And here we can see very strong growth numbers forecast in US construction spending, which would obviously be extremely good for Heidelberg. Harley-Davidson, which we sort of touched on earlier, this business again has derated. It's suffered a little bit from a stronger dollar. The key for us in this stock is a pickup in bike sales. So here you can see, going back to 1990, we saw this acceleration in bike purchases on an annual basis going through to 2007. And here you can see a point where obviously credit availability fell very dramatically, and therefore bike sales fell very dramatically. As you can see here, we haven't seen any sort of pickup back to 2007 levels, and we're forecasting with credit becoming more available that will be the case. It also is a case that more people have been buying second-hand bikes. These are new bike sales, and as we move through that product cycle and this sort of glut of new bikes that have become second-hand bikes age, then we think we'll see new bike sales picking up. So we're pretty positive on that. Finally, we've got Microsoft. Just looking at why we like Microsoft. So some of the parts argument. So just looking at the business, we've got the commercial and the consumer licensing. So that's Windows, that's Office. Just putting that on a P that's similar to SAP as an example. You've got a market value of around 278 billion, and equally consumer licensing, 62 billion. Looking at their cloud business, which is a big business now, putting it on the same multiple as Amazon Web Services and Salesforce would give a market cap of 60 billion. And then Bing, we just put it on the same valuation, 8 times EV to sales as Yahoo, giving 20 billion. So you add all that up and you get a sum of 420 billion, which is a 20% discount, so a 20% premium to the current market cap, which is around 383. And that's implying no valuation for Xbox, who are leaders in augmented reality and virtual reality. Surface, which is their tablet and phone, and obviously they bought Nokia's phone business and are looking to implement Windows onto the phone and solve the app problem that they've had to date. And if they can do that, again, the significant value that could come from that business. So all of that is in for free. So that's why we like Microsoft. Anyway, that's it from me. Thanks for listening. Have a good weekend.